Hi guys, Max here, and this is your daily market update for what happened yesterday, the 23rd of June. And as you can see from this graph behind me, actually it was relatively good for equities for a couple of reasons that we'll get onto into a moment. But as you can see, it's mostly green. Tech did relatively well with the Nasdaq slightly outperforming the rest of the indices. Healthcare was quite strong. Consumer defensives were quite strong. Financials were slightly weak though. Again, we'll get into why that is in a moment. And then energy was weak as well, simply because oil prices fell a little bit more. For the whole then, the S&P 500 rose by about 1%, while the Nasdaq rose by about 1.5% and the Dow Jones by 0.6%. Now, in the rest of the world, it was actually a little bit worse for the most part. The rest of the Americas was quite poor. Canada didn't do very well. Central and South America didn't do particularly well either. Europe was quite weak. The FTSE 100 fell by 1%. The Stoxx 600 fell by 0.8%. And so on the whole, the MSCI World Index actually fell by 0.5%. The dollar didn't really move against the benchmark of its peers, but the euro did fall against the dollar by about 0.5%. It's back down to $1.05 now. The pound is still sitting at $1.23, and then the yen did a little bit better than usual and rose to 135 yen per dollar. In the world of fixed income assets in the bond markets, we had another day of frankly huge volatility, with the US 10-year Treasury yield falling by 7 basis points down close to that 3% mark, 3.08%. The German 10-year yield fell by 21 basis points and the British 10-year yield fell by 18 basis points all across one single day, basically because investors and speculators are gambling about the recession changing how central banks are going to be treating their monetary policy into the future. Oil prices then fell again slightly. WTI crude fell about 2% from yesterday and is down at $104 a barrel. Brent crude oil is sitting at $106. Gold prices fell very slightly down to $1,830 an ounce, but no significant moves there. So why did stocks perform this way? Why were American equities up while bond yields were falling and so bond prices were up? Well, it's mostly because of these recession fears that we've been getting a lot of news about recently. Demand for copper and other commodities which tend to indicate which direction the worldwide economy is going in. Well, demand for those commodities fell. Jobless claims in the US is actually higher than usual, which isn't necessarily good. But this means that the economic outlook for the US is bad, and that's good for equities in a weird roundabout way. Basically, what the markets are trying to price in right now is the economy hitting a recession or crashing sooner than it had previously expected. And so the Federal Reserve, if a recession really does kick off and destroy the world economy, well, then the Federal Reserve and other central banks, they're going to stop their quantitative tightening. They're going to stop raising interest rates, and they're going to go back down to 0% interest rates and printing money willy-nilly all again to try and turn the economy back around. And so the markets are sort of taking bad economic news as good news for the markets because it might mean that the monetary environment is going to get better into the future. In the world of crypto, it looks very green on this graph, but in reality, there haven't been major changes for the most part. Bitcoin is still below $21,000. Ethereum is still below $1,200. Most altcoins did gain another 2 or 3% over the last day, but again, they're still at historic lows, at the lowest points we've seen most of them in about 2 years. So no real major shifts there. There has, though, been some actual pretty bad news coming from crypto, coming from what is called the Harmony One bridge, a protocol that basically makes it easier and possible to transfer between various networks, the Ethereum network, Bitcoin, the Binance Smart Chain, and then Harmony itself. And basically, this protocol was hacked for $100 million. Now, they've come out and said a few different things. The first thing is that apparently the Bitcoin bridge, which is their main one, has not been affected at all, which is a silver lining, I guess, but still, this is not good news. Someone just stole $100 million out from this protocol. The reality is that this kind of stuff is just super common in decentralized finance. And it all comes from the fact that we're still early to this space. Smart contracts are great. They can be really, really useful. But when there are flaws, those flaws can be exploited, and it becomes easy to literally steal money out of what basically amounts to people's bank accounts or institutions' bank accounts, something that doesn't really happen with traditional finance at all. Another big problem with things like this is that it's very difficult to actually get your money back once it's stolen. As you can see from this second tweet that Harmony put out, well, they know who has the money. They have the address listed right there that is holding all of the money that has been stolen. But that doesn't really mean anything because it's a decentralized network, so they can't just get their money back like they could if this were a traditional finance setting. As a result, this organization, and when organizations in general are hacked in DeFi, they're pretty much resorted to negotiating with those hackers to try and get them to give back the assets, usually in exchange for maybe 10 or 20% of what they stole, or they just appeal to the hackers' good nature because sometimes they are happy to return it because they don't want to go to jail for stealing money and things, and they actually just wanted to expose a flaw in a system rather than profit from it. There is a problem for the hacker as well. It's actually a little bit difficult to get access to this money. Yes, it's in that wallet there, this address that is listed. Yes, they do technically have that money at their disposal, but major exchanges like Binance and Coinbase will usually basically blacklist these sort of addresses and any addresses that work with these addresses to try and make it difficult for them to get that money out. So with hacks like this, you often have a lose-lose situation where the hacker doesn't actually make any real money and the organization loses money and investors lose money as well. And that seems to be likely what's going to come from this in the end. This certainly isn't good news for crypto. Now, in the same sort of vein, Coinbase is getting rid of their pro version of their app or their exchange. They're basically killing it off and they're replacing it with something that they're just calling advanced mode, which is going to be in the main app. Now, this kind of makes perfect sense because Coinbase versus Coinbase Pro has been an awful system for a long time. It isn't streamlined at all. They are two separate apps and two separate platforms just for basically a paid version of the other one. It's always been a little bit awkward, and it means that a lot of customers don't get access to products that they could have had access to and that would have saved them lots of money because they just didn't know they were even available. This is supposedly going to fix that problem, and so should be good news for Coinbase users. There is, of course, the chance that Coinbase use this as an opportunity to change their fee structure to try and squeeze more money out of their customers. It's also possible they move into the institutional vein of being an exchange and start to compete with FTX in that sense, which again would make sense for Coinbase as a business decision. Coinbase has suffered a lot recently over the last year or so with their share price. They went public last year in 2021 to so much fanfare. Pretty much every major YouTuber was buying their stock at IPO for something stupid like, I think it was $300 a share. It's now trading for a mere fraction of that. And the company is sort of in that similar situation to Robinhood, being grossly undervalued, actually a really good deal in a lot of different ways. But the monetary environment is just so poor for crypto and for Coinbase right now that it doesn't really matter, and it's probably going to see its share price continue to fall. Crypto exchanges in general are in a very turbulent time. They are competing for a diminishing pool of users. As the crypto bear market starts, investors will start to leave, and they already have started to leave actually. Binance has come out and removed all fees for Bitcoin trading, which is going to attract a lot of customers. And I think we're going to see a race to the bottom, like we saw with traditional brokerages when Robinhood came on the scene and offered commission-free trading. We're going to see crypto exchanges go in that same sort of direction over the next years, and it's really going to eat away into the margins and the revenues of companies like Coinbase. Now, something that I don't usually talk about is the fact that Vladimir Putin came out and gave a really long speech yesterday, and a lot of it was the usual spiel from him. The sanctions against Russia are failing. They're causing more harm in the West than in Russia. Inflation in the West is out of control. There's an energy crisis. There's a looming recession. Money printing was irresponsible, and that the West in general is net importers. You can go and find the speech if you want, but really it's the same sort of thing that Putin says, every couple of weeks when he has these sort of speeches. There wasn't anything groundbreaking there. But what was quite interesting was that it all tied together at the end, and he basically spoke about how the euro and the dollar are losing their position as the world's reserve currency, and that this is the end of a unipolar world where basically the US dominates everything. And so I thought I'd just very briefly talk about this and give my point of view on this, because frankly, it's getting quite a lot of attention, especially amongst people who might want the US to lose its position as world hegemon. But in reality, things just aren't that simple. And while the US is probably past its peak power in comparison to the rest of the world, well, it certainly isn't near the end of its reign. So Putin basically made this argument that monetary sanctions in particular, basically the US and the West in general, locking up Russia's foreign currency reserves and stopping them from using them, well, that erodes away the value of those foreign currencies in the first place. And he's absolutely right that it does erode away that value. And he's basically said that we've already seen the start of the end of the US dollar and the euro as reserve currencies, as having that status. And it's a very popular talking point. The problem is there's no data to back this up. About 85% of world reserves are either the euro or the dollar, and then 95% are actually Western aligned currencies. So the other 10% is made up of the pound, of the Australian dollar, of the Canadian dollar, and then just 5% of world's reserves fiat currencies are in the yuan, nothing in the ruble at all, I'm afraid. Putin was sort of pushing for this idea that it's going to move to commodity reserves, which again, there isn't really much evidence at all to actually suggest this is the place. There are a lot of crypto bros out there saying that actually Putin was indicating that it's going to shift to Bitcoin. Again, Putin didn't actually say that at all, and there's no evidence to suggest this is the case at all. I do feel that we're going in this general direction, that yes, the US's days as the world reserve currency is a little bit numbered, but we're talking a century or so until that's gone. I'll probably be dead, you'll almost definitely be dead, and we will never really see that. Now, the final topic to talk for this video today comes out of Netflix. And again, it's just this general idea that a lot of companies in the US, companies which were, massively revered for being so successful over recent years, well, they're starting to have trouble and they're starting to fire their staff. Netflix has just fired 4% of its workforce this month so far. That's 300 employees. Last month, it fired 150 employees, which was 2% of its workforce. So they are really cutting away the chaff. Netflix is another one of those infamous companies, a little bit like Twitter, where they hired software developers for ludicrous salaries and gave them ridiculous perks, so they weren't necessarily working as hard as they should have been, and they maybe weren't worth their salt. As capital just becomes more scarce in this new environment, as a recession creeps up, companies are going to have to change, and they're going to have to be more careful and more selective with how they spend their money, and that's just simply what we're seeing here. Netflix in particular has actually struggled and is seeing its business and its growth in particular wane by quite a lot. Its stock performance itself has been absolutely awful. We've had two separate occasions where a $100 billion, what was $500 billion stock at a time, well, it dropped off a cliff by 20% over the course of a day. That's not healthy for a company like this. They've been investing in weird woke shows that frankly no one really watches, like Cuties. I'll try not to get too political on this channel, but check out Cuties if you want. It's pretty disgraceful that Netflix put that and published it on their site. Netflix is actually trying to innovate to try and maintain their growth, but it isn't really working so far, and they're not moving quick enough. They're planning a cheaper ad-substituted subscription in the future, which should help them to get more people. They're planning on cracking down on account sharing, and they're releasing shows a little bit periodically rather than all in one go to try and stop people binge watching for a month and then cancelling their subscription. Frankly though, all of this stuff should have been done over the last year or two. They are now late to the party, and they're no longer the disruptors or the innovators in this market. Frankly, this is just one more example of companies being forced to shift their strategy because the tech bubble is well and truly over. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to iTrust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join iTrust Capital. Thank you all for watching. Stay stoic. Until next time.